Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, January 16th, 5:17 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in an uptrend. You can see the trend gauge over here. We've got the coveted 4 arrows. However, on short term, we got a second close for small caps below the 21 day and the first close for mid caps below the 21 day. So we've got the yellow sub arrow on there. Leaders holding up fine. Some acting extremely well, some coming back from the dead, some starting to lag. A little bit of a mixed bag, but no serious red flags. Medium term and long term, all 5 of the major indexes are trending above their 50-day moving average and 200-day moving average. So what happened today? We were down right out of the gate as the dollar was strong, yields were rising, weak economic data came in before the open. The New York Fed Manufacturing Index, with its weakest reading since April of 2020, that's going back to COVID. So that's hinting at an economic slowdown. At some point, the markets will get more concerned with an economic slowdown than they will be with the Fed and interest rates. Then in the afternoon, we had one of the hawkish Fed guys come out and say that they didn't need to be in any hurry to cut rates. And the market was volatile today, volatile trends, and that caused the most severe weakness, a little bit of a rally into the close, but we still closed red across the board. Here are the numbers. The big 7 just barely negative. RG8s, our 8 growth ETF composite, down 0.5%. S&P 500 opened down 0.35, was lower, was higher. It went above and below the opening 30-minute range. That's on the volatile side, but basically closed where we opened after a bit of a rally into the close, down 0.37%. Equal weight, lagging again, down 0.63, and it broke the 21-day moving average. NASDAQ 100 just barely negative, equal weight, down 1/3%. Dow down 0.6, mid caps down 0.65, Russell 2000 small caps down 1.2, Global 60/40 down 0.75. Both global stocks and bonds were down. Bonds prices took a hit today as yields spiked, and in-house GROTECTION down 0.38%. We pulled 2 weeds, 2 of our weakest positions hit their stop. We'll talk about that when we get to the charts and the tail of the tape. And here we go. We'll start off with the S&P 500 here. This looks, let's go with the 15-minute chart here. So you can see the move up here, January 8th. This was last Monday. It was just a big, strong trend up day. And since then, we've basically gone sideways for the last 5 trading days. Tried to break out twice near this 4,800 level, turned back both times. So 47.90 for now is resistance level. And on the downside, pullbacks, 47.30-ish on the downside, which is pretty much this breakout level you can see back here on January 3rd. So it's flipped from resistance to support, and we'll wait for this range to resolve one way or another, as it always does. But for now, the nice bounce off the 21-day moving average is working. We undercut and reclaimed the 8-day moving average today on the S&P. Let's go to the NASDAQ 100. Bounced off the 8-day EMA. Nothing wrong here in any way, shape, or form. Let's go to the Dow. Some of the higher price components have gotten weak lately. You can see the relative strength line over the last week and a half trending lower, but it undercut and held the 21-day moving average today. Mid caps, the MDY ETF, you can see the entire range below the 21-day moving average today, and IWM closing near the bottom of the range in this 190 level. If I go to the weekly chart, you can see how it bounced right at the 10-week moving average, which is at 190.59. We closed just barely above there. Today's low needs to hold. You can see this is 4 weeks down off the highs. Relative to where we went from the low to the high, this is a normal pullback. but we need to hold these moving averages. Obviously, some big relative weakness over the last 3 weeks, 3 to 4 weeks in small caps is hitting the breadth numbers as well. Let's go to the VIX. Not a good day for the VIX, gapped above the declining 50-day and 21-day moving averages, but kind of in line with what the indexes were doing. Let's go to the US dollar. This is one of the problems today. You can see the gap up closed at the highs of the day, right into the declining 50-day moving average and 200-day moving average. So, but we did break out of this consolidation, and that corresponded with weakness in stocks. And we don't want to go higher on the dollar. Obviously, the higher dollar signifies a headwind for stocks. And gold stocks didn't do too well today either. Here's gold down 1%. Here's GDX gold stocks down 4.4%. Ouch. How about Bitcoin? This is still trying to figure out what it wants to do. It did bounce at the bottom end of this range. I talked about this in one of the videos last week, but held where it needed to for now, right near the 50-day moving average. Now to the downside on bond prices across the board, down 0.7 on the broad bond index, TLT down 1.7%. That means the TYX will be higher, up 2.5%, and the TNX, the 10-year bond, also higher, up almost 3%. That's our inter-asset correlation. Let's hit the tail of the tape. You can pause this. From a stochastic standpoint, only the S&P and the NASDAQ of the big five indexes are healthy. 6 of the RG8 negative stochastics. Same thing with the NASI, the dollar, and rate. So it's not a surprise. We got oversold. We had a big rally, but at some point, the bulls are going to have to show up, especially in the mid and smaller names, to start putting in a bottom during this pullback. We can't just have a handful of big cap names holding up the market. There's the news about the manufacturing index and the Fed Hawk Waller day count up to 4-day consolidation, undercut and reclaim 6 days up on the 8 EMA, 7 on the 21 EMA. Sectors, marijuana and semiconductors were about the only things that stood out today. And then unfortunately, the strong dollar. On the downside, Bitcoin, although well off the lows, gold stocks, biotech, oils, regional banks, Chinese internet, and biotech's weak. The two sells that we did, FCX and PDD, we'll look at those charts in a minute. Bottom line, volatile action as rising yields and strong dollar hit stocks. No, as long as we stay above the 21 on the S&P, the market is fine from a broad market perspective, and that, again, that's being held up. Despite some weakness in Apple, the rest of the and Tesla, the rest of the big cap stocks are pretty much holding up okay. So here's the two that we sold today. First one is FCX, and copper doesn't do well in economic weakness in that New York Fed manufacturing index, and I think there was some bad news out of China as well, but broke the 21 where it had been holding. It rolled over. It's down 5%. We took our 0.2% hit to the overall portfolio on the two buys that we did. So right in line with our max loss. Yeah, I see it's at the 50-day moving average, but when your stop gets hit, your stop gets hit. Also, PDD undercut the 21-day moving average, tried to rally up into it a couple times and failed. We took our 0.2% of AUM loss on this one as well. What's continuing to act well and hold up the portfolio? Uber continues to act great. AMD, multiple upgrades today, up 8.3%. NVIDIA also with an upgrade, up 3%. Those are 3 of our 5. We're down to 5 individual names. Lilly, the 4th one, and SMCI, very volatile today, but held the 8-day exponential moving average. Those are the 5 remaining tickers that we own. From a sector standpoint, we also own ITB, which is Home Builders ETF. We own it through Nail, the leveraged ETF, and we also own uranium, which also had a volatile day. It's extended though. A pullback is almost required at this point on uranium. I guess nothing's required with the market. obviously, but that's what we look at: probabilities and possibilities and likelihood and expectations. And when things get death, taxes, and reversion of the mean are the three things that you can count on in life: reversion of the mean in the stock market. So those are the names that we own. What did well today? A couple things. Datadog, DDOG, has recovered its 21-day moving average and continues to make higher highs. So remember this pattern. We saw a lot of it the first week. Multiple leaders from last week breaking back below their 21. Second week, we saw a bunch of them, maybe half, regain their 21. Now, where's the relative strength showing? What are the ones that are making higher highs versus last week? Those are the ones that we're focused on this week. Datadog, one of them. Deckers, another one. MongoDB got back above the 21 for the first time since it failed, or closed above the 21 for the first time since that failure. Abercrombie and Fitch continues to stay strong, but on the other hand, another clothing retailer, Gap, broke the 21 today with a gap down. Gap down, get it? Two other very strong ones: ESTC showing higher highs, and ELF, ears, lips, face, working good. Reclaim the 21 and making higher highs. Let's see what else. Vertex VRTX, medical stock, continues to act fantastic. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. We reply to all emails, and also if you post a comment on our YouTube page, make sure you like and subscribe. That helps get our content out there. We appreciate that. If you're interested in becoming a client, email my partner, Dan Stewart, Dan@RevereAsset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much of that you can keep. Right now, we're consolidating on the NASDAQ 100 and the S&P 500, but we're seeing weakness on small caps. There's the IWM and mid caps, and the equal weighted S&P index. This kind of usually acts like the mid cap index does. But break below the 21-day moving average today. We want to see it get back above there. So, and with that, I'll wrap up the video for Tuesday, January 16th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.